The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, the man who has more faults than Wimbledon. It's Anthony McDonald. How are you, Anthony?
Got me there, James. Straight down the centre line.
Fantastic. This week we examine what your super fund did for you last year. We deliver a corporate mess with the lot at Domino's Pizza, and we welcome another rising star to the ASX. Well, let's start there, Anthony. And last week Virgin soared onto the ASX board with its IPO, and this week we had another big float. Tell us a bit about Genlife, a company that few of us will have heard of, but it's got one of those great Australian entrepreneurial stories behind it, which I just love.
It really does, James. It's a lovely story. So you got a bloke called Peter Puljic and his wife. They come to Australia in the late 1960s from Croatia.
Yep.
They landed at Villawood Detention Centre here in Sydney, get billeted out to Bondi. And this bloke apparently taught himself how to render buildings on the Bondi toilet block at Bondi Beach in the late 60s. Came to Australia with nothing, got picked up there, started working as a plasterer and a renderer. And the story goes that after a few years, his boss gave him a plane ticket to Palm Beach.
Right.
And he said, why do I need to go on a plane to Palm Beach? Like he thought they were talking about Palm Beach in Sydney on the northern beaches where they film your favourite TV show, Home and Away, James.
Love it.
But they were talking about Palm Beach on the Gold Coast. So he relocated the family to the Gold Coast. Things got bigger and bigger, set up his own business.
Yep.
Sort of bought like a caravan park to house his workers and house his materials. And he saw next door they were building this over 50s temporary housing sort of village, and he couldn't believe how shoddy the building practices were.
Right.
He thought it was shocking that people were going to be putting their parents in fridges, as his son relays the story. So he came up with his own sort of method of building these over 50s parks, a little bit more solid and stable. Fast forward 30, 40 years, James, and you've got a $1.5 billion plus business listing on the ASX. So it's a bunch of over 50s villages. They're, those small sort of gated communities.
Yeah.
You pay sort of $250 a week in fees to sort of maintain the site. And then you also buy your house for about $750,000 or so.
Yeah. This is a really booming industry. I think that land lease is what they call it, isn't it? You lease the land, you buy the house, and it's a more affordable way in because these houses are like essentially temporary structures.
Yeah.
So, Anthony, why are they listing? I mean, this sounds like it's grown like a weed in private hands. What do they want to come to the ASX for? I mean, it's great to have them, obviously.
Yeah, it has grown like a weed. They're pretty expensive to do, James. Like it is capital hungry, this development. Like you are buying sites. Yeah, they're vertically integrated, so they do the development, everything themselves. But it does consume quite a bit of capital. They've had a group from Singapore that's backed them for the past 5 or so years called Thakral.
Right.
And I guess they're just looking to set it up now for the next 40 years. One of Peter Puljic's son, Adrian, he still runs the business. He's a major shareholder. It's a nice story for investors. But yeah, for investors buying in this week, James, all that matters now is what happens next. It's nice hearing the lovely story in the background, but it floated on Thursday. It was up about 5% on day one.
Nice.
A good result. I mean, probably wasn't as much as those involved in the float were expecting, but it was a credible debut. James, you used to edit the Rich List, and you've heard plenty of these rags to riches stories. Any stick in your mind from over the years?
Oh, look, so many of them. Our Rich List is loaded with these great immigrant stories. I mean, there's the great ones like Frank Lowy, came here like so many of the Rich List members out of Eastern Europe after the Holocaust and settled and built businesses. Those guys landed with zilch in their pockets. I'm not sure they were rendering the dunnies on Bondi Beach, which is just such a good image. Imagine what his first apartment was worth in Bondi these days. But there's all sorts of different stories. There's a guy up in Queensland, John Van Leeshout. He founded this Super Amart furniture chain. Mm-hmm. Later sold it to private equity, but ingeniously kept all the property for himself, which was very clever. I mean, he was a Dutch immigrant, came out here. I think he started working at the age of 14.
Wow.
Like, imagine doing that these days.
Yeah.
I got a couple of teenagers at home. Do you think I could send them out to the loading bay of the local furniture store and say, just have a crack, boys? So these stories are great. And I think it's great when they come to the ASX and people can sort of get to know the business and get to know the family. And, you know that family will work their bums off to make this thing work. That's the magic of founder-led businesses on the ASX. They got a reputation to protect. They got their baby to protect, and they'll go the extra mile for you. And investors love that, don't they?
Yeah, they sure do. And I reckon we'll see the Puljic's on the rich list next year, James. They've done very well out of these land lease communities. Now, James, Qantas has been doing a great job of keeping its wings largely out of trouble in the past year or so. But that came to a screaming halt this week when they suffered a cyber attack. James, the method of attack was really interesting. Can you tell us about it?
Interestingly, a couple of days before this cyber attack, the FBI in America put out this warning that a hacking group called Scattered Spider was going after airlines, and all of a sudden Qantas gets hacked. Now, we don't know if it was Scattered Spider but the methodology is similar. Instead of sending a phishing email, which we're all, warned never to click on, these guys get on the phone and go old school. They ring up someone in the business, someone in the call centre, might be on the IT help desk, or in Qantas's case, it was in a third-party controlled call centre. And they say, they spin them some sort of story, I've lost my credentials, whatever it is. And they basically get around things like multi-factor authentication, when you get a code sent to your mobile phone to identify yourself as you. They get around all that stuff by just conning the person on the other end of the phone line to give them access to the system. And that's exactly what happened here.
Wow.
So these hackers got access to a third-party system that's got all Qantas's records in it, 6 million records. Now, fortunately, no passport details, credit card numbers, that really valuable financial-related information. None of that was stolen. But it is names, addresses, email addresses, birth dates. So it's not, nobody wants this stuff to be out there, absolutely. But I think this is a big story. I mean, I wrote on Wednesday, it's really the first crisis that Vanessa Hudson, the Qantas CEO, has faced. But what's interesting is how quickly the crisis has faded. I mean, Qantas dealt with it pretty well, I thought. They got on the front foot, got onto all 6 million customers, said this is happening, your data might be at risk. But is there any chance, Anthony, after the hacks at Optus and Medibank in recent years, people are sort of desensitised to this stuff? We almost expect that our personal information is going to get hacked, as bad as that sounds.
Yeah, I agree, James. I think there's a bit of a hack fatigue. People are a bit more accepting of the details being out there. I mean, in terms of credit card numbers and passport numbers not being released, I mean, that's well and good, but they've got your date of birth. And the last time I called up, AGL Energy or Telstra or whoever, the only thing they're really after is your name, your date of birth.
Yeah, true.
And your address, right? So I do think the hackers have got their hands on some pretty valuable data. I mean, I also wonder if there's a bit of a spin job going on here as well, James. I mean, in the paper today, we were reading stories how Qantas sort of knew that the hackers were out there, and they'd sent the message out to their IT teams and asked them to pass them on to their teams, like, be extra vigilant. The hack's going to go on.
Yep.
And they still got hacked. They got a pre-warning here.
Yeah, true.
If I'm playing cricket and the bowler's good at bowling on the stumps, you're going to play straight.
Let's hope we don't see any sort of Qantas customers suffering in the next few weeks. The shares dipped a bit on the day of the hack, seem to have largely recovered. I mean, Vanessa Hudson's fortunate in a way that she's playing with plenty of credit in the bank. Qantas shares are still near record levels, so that's a good news for investors, right?
Yeah, absolutely.
All right, Anthony, let's move to our first topic. And with June 30 now in the rearview mirror, happy new financial year, everyone. Australia's giant super funds have started releasing their returns for the 2025 financial year just gone. Anthony, let's get straight down to it. How did we go, and what was the big driver of returns last financial year?
Strong year, James. I mean, we've seen a few results this week. I think most people that are in the sort of balanced or the growth funds of the major funds at least should be expecting, high 9s, 10, 11, 12% even.
Yep.
A bit better than the 3, 5 and the 10-year averages from what I've seen, which is good news for retirees. It's good news for all the workers who are piling a lot of their savings into their retirement bundle every fortnight or so. But I must say, all the funds, I mean, they seem pretty clustered around each other, don't they? Which is what they've been made to do by the regulation. The way that they're benchmarked against each other, the way they're benchmarked against the benchmarks really encourages this sort of clustering of performance. And don't get me wrong, if someone outperforms someone else by 1%, that's great and it's meaningful. The big driver, James, was equities, listed equities, as it has been for the past 3 years now. I mean, US shares, which set the tone for the whole world of equity markets. I mean, they've had a huge 3 years, despite Trump, tariffs, Liberation Day, all that sort of stuff. Australian shares also did really well.
Yep.
And they've also done well post that sort of Trump volatility, picking up quite a few investors coming to Australia for a bit more stability.
Yeah.
That's the main driver. James, I mean, you spoke to the chief investment officer of our largest super fund, the $365 billion monster Australian Super. His returns were a little bit under the broader industry.
Yeah.
Like, we'll have lots of Oz Super members listening. What did he get wrong?
That's a good question, Anthony. What did he get wrong? Did he get anything wrong? His name's Mark Delaney. He's the CIO of Oz Super. He's a pretty considered guy, absolute veteran in the industry. And basically what he said was, yeah, okay, you wanted to be in listed equities, as you've said, US shares, Australian shares, but you wanted to be in a very narrow band of listed equities. You wanted to be in, get this, 9 stocks.
9, wow.
So that's the Magnificent 7. So we've got Apple, Alphabet, Amazon, Nvidia, Microsoft, Meta Platforms, and Tesla, plus one more, Broadcom, which is another chip maker. So I call that the Magnificent 8. Mm-hmm. And then in Australia, you just wanted to be in the Magnificent 1. Our old friend Commonwealth Bank, 30% of the returns on the ASX 200 during the financial year came from one stock.
Wow.
So, okay, so you just want to be in 9 stocks. But should you just be in 9 stocks? As you said, the return from Oz Super was high 9%. Most of the rest of the industry is going to do low double digits, somewhere around 10.5. I don't think any Oz Super members should be going, oh no, I've missed out on that 0.5%. You're in Super for 30 years, and what we've seen is that Oz Super has taken some decisions about how that run that you've seen in those 9 stocks can continue. Where does it go next? So, for example, in CBA, the CBA is now, its index weighting, so how much of the ASX 200 it accounts for, it's now 12%. In the last 3 months, Oz Super's taken their weighting of their portfolio in CBA shares down to about 9%. So they're 3% under the index. And what that says is they're looking at the share price, like every analyst and investor in the world, and saying, oh my God, that is really overvalued. No one can argue with that, but they're actually doing something about it. What are they doing instead of that? They're rotating into mining stocks, into the resources industry, where valuations have become depressed, and they think, well, that's the next thing that's going to go on. So we're starting to see, Anthony, a bit of a rotation out of the banks and into the miners. Now, people have been predicting that's going to happen for some time. It does appear to be starting to happen. I think we want a bit more data before we get really excited about it. But that's a decision that Oz Super's made. They're coming off the banks a little bit. It's cost them a bit of performance, but they think it's going to mean a little bit less volatility for members. And you've got to remember that that's the point here. Super returns aren't sort of isolated from the rest of the world. There's actually people who are retiring and need to use those returns to enjoy their retirement. So that's I think that's the thing we sometimes forget, and that's a really important part of the process. So I don't think it's necessarily a bad thing that Oz Super's marginally trailed the rest of the pack. They're taking some decisions that are quite logical. Anthony, we talk absolutely endlessly on this podcast about private markets, private equity, private credit, venture capital, and we're always told by the super funds that they hold lots of these assets and make a really important contribution to super returns. Was that the case last year?
Yeah, absolutely. They made an important contribution to returns, James. I mean, you had Australian Super. I spoke to the number 2 fund, Australian Retirement Trust, on their private market stuff, real estate, infrastructure, PE. They made decent contributions. I mean, the infrastructure portfolio there was pushing sort of 10%, a little bit more. Real estate and private equity did a bit less, but I mean, it's all kind of helpful. But I mean, you have to have those assets for diversification. over the long run. And look, in the year just gone, you would have been better just going all in on equities.
Yeah.
As you would have for the 2 years prior to that as well, James. But these funds, they set up their asset allocation on the belief that over the long term, diversification is the best bet. And, they've all got their academic research for doing that. I was struck by a couple of things in private markets this year, James, from my conversations.
Yep.
The first was that the super funds, they're taking a much more active approach to these investments that we normally think are quite illiquid. Like we've seen them buying anything that isn't bolted down in Australia for the past 10 or 15 years now, James, hoovering up assets, their funds under management's been growing and they've really been hungry buying stuff. Now we're sort of hit a tipping point where they've got these assets that they've owned for, 5, 10, 15 years.
Yep.
And they're starting to realize some of them. Maybe they're not growing as fast as they used to. Maybe they just think that asset, it's about to enter sort of like the next chapter of its life, needs capital investment or whatever.
Yep.
And it would be better off for someone else to do it. So they're selling things. So, this week we saw Aware Super, that's a $200 billion fund, sold a chicken producer called Protein, which is an infrastructure investment, James, believe it or not.
Really?
We saw Australian Retirement Trust sell its stake in AirTrunk as part of that big buyout last year. It sold its stake in the Gold Coast owner, Queensland Airports as well. So they're starting to turn over more assets. In terms of private equity this year, James, it didn't go as well as public equities. And once again, I think that's kind of by design. The more I talk to the chief investment officers about this, the more it's pretty apparent that private equity, it's there as a bit of a returns smoothener or returns buffer. Right. It doesn't go as well in the up years, doesn't go as badly in the down years. So in good years like this, I think they don't revalue the private equity stuff as highly as the equities market, and it smooths the returns. And I think that's why we're getting these year upon years of 8, 9, sort of even 10% returns.
Yeah.
And the last one on the private markets, real estate, from what I got out of Australian Retirement Trust, and CBUS said this as well, it feels like there's a bit of momentum coming back into real estate.
Definitely.
It's been in the doldrums, but interest rates are supposed to be coming down, which should push asset prices up. There's this realization that things that are actually built across property are sort of more valuable than things that you can build at the moment, because the cost of everything's through the roof. Labor is obviously expensive. We had inflation on the actual building materials themselves. So I think the private markets are doing their job, but at the end of the day, it was a year for equities, another year for equities. James, another big movement for super this week was the increase in the super guarantee to 12%. So that's how much of your wages each week are mandated to go into super.
Yep.
And I wanted to bring in a question here from Caroline Hutchison, who saw a story from the CBUS chairman, Wayne Swan, this week. Now, Wayne Swan was reacting to Paul Keating's comments, who said the super guarantee should go to 15%. Swan says, no, they're all good at 12%. When I was treasurer, I mandated 12%, and that's the right level. Caroline wonders, James, how do you think he reconciles that? He's chairman of a super fund. You'd think assets going up there would be a good thing. You think he'd be for retirement savings. Why do you think he thinks 12% is a good level and we shouldn't be going up to 15%?
I think Wayne Swan's sniffing the breeze a bit here.
Yeah.
I think 12% of having 12% of your wages, you're forced to save that. I think that's we're getting towards the top of what the community will accept.
Yeah,
we're mandated to save. That's a big chunk of change. You ask a 20-something or a 30-something, would you like to be forced to save, put away 12% of your wage for sometime when you turn 70, or would you like to use it for your house deposit? I reckon they'd be a bit torn on that. So I think anything above 10%, I think we're starting to get into territory where people start to go, oh, really? I'm putting that much aside for my retirement? And I think Swan's sniffing the breeze there. He's saying, we're now at a level where if we take it any further, there'll start to be pushback, and that could weaken the broader case for superannuation. The idea of forced savings, it's one that you need the community to get behind and accept.
Yeah.
So I think that's what Swan's talking about. I don't think he's saying it's not either or. It's not either increasing the savings or managing the money better. Yes, we want to manage the money better, but I think he is saying we've taken that level as high as it can go. I think that's my interpretation.
Yeah, I read it similarly, James. I think, obviously overseas a super fund, if more money was going into CBUS, that'd be great for, his job, his investment team, I'm sure they'd love spending it. But it's a real balancing act, and we're at 12% now. I mean, that's a big call on both the employees, whose 12% of their wages are going into super, and also the bosses as well, who actually have to pay the wages. The more you're putting into people's super, I mean, the staff, they still need their money to pay their bills, buy their houses, do all that sort of stuff. So it's a real balancing act. And I took that 12% versus 15%. It's just like a bit of a gut feel about what's fair. I mean, Swan's article was kind of interesting. He was more arguing more broadly that the super system's done really well of helping people accumulate assets.
Yes.
Now let's work hard on the decumulation side as people get older. Let's help them transition to retirement a bit more easily.
Yeah, Caroline, I think the super funds are still going to work really hard for younger people who are in the accumulation phase. They want to build those piles of cash up as high as possible. But I think the super sector does need to recognise we're at a bit of a tipping point here as the population ages. They've been all about growing the pie, and now they have to be about making sure that they distribute other people's money back to those people in the best way possible. Anthony, crystal ball time. I know this is really hard, but as you said earlier, we've had a few years now of sort of, high 9s, 10, 11% super returns. They're being nicely smoothed out by those private assets. Can I just bake in 9, 10, 11% for the rest of my life?
I'd like it if they could, mate. I'll tell you, if my super fund offered me 10 or 11% for the next 5 years, sign it today.
Yeah.
I think that'd be good. I reckon they'll struggle to do that forever. To be honest, I mean, equities, like I said, they've had 3 very strong years. Remember, that's sort of rebounding off COVID. It's the tech earnings. It's the AI hype sort of era. I'm not sure that's sustainable, and you'd think equities will have to take a breather at some stage. And equities are 55 to 60% of most balance and growth funds out there, James. So if equities are flat, and they are a bit more than half your portfolio, you're going to struggle to get to 10, 11, 12% just by investing in infrastructure, real estate, private equity, bonds, cash, all that other stuff. So I think in terms of this financial year that we're starting now, the market's rallying, and I'm not sure that's necessarily about to end anytime soon, but I think over the long term, 8 to 9% is what I'd be asking my super fund.
Yeah. Mark Delaney from Oz Super, he reminded us yesterday that the sort of promise they have with members is they're going to do inflation plus 4%. Mm-hmm. Inflation's somewhere around between 2.5 and 3, call it 3. That's a 7% return. Inflation's probably coming down to 2%. That's a 6% return. That's what you sort of should expect over the long term. So we're actually in a really good period at the moment. And I'm with you. I think just be careful about thinking that what we've had for the last 3 years is set and forget.
All right, James, let's get to our second topic, and it's something that we know a lot about on the Chanticleer podcast, pizza. Domino's Pizza Enterprise, now that's the master franchise owner for the Domino's brand in Australia, New Zealand, Belgium, France, and a bunch of other countries. It's looking as soggy as a 3-day-old piece of barbecue meat, lovers.
Oh.
This week, James, Domino's announced it was looking for its third CEO in less than a year. The current boss, Mark van Dijk, is leaving after only 8 months in charge. Of course, he took over from the irrepressible Don Meij, who ran Domino's for more than 20 years. And in the interim, the company's 82-year-old chairman, the fast food veteran Jack Cowan, a rich lister, he's stepping up as executive chairman. James, Domino's shares tanked nearly 25% on the news. Do you think that's because the market was shocked by the departure? Or do you think the market has thrown Domino's in with WiseTech and Mineral Resources and a bit worried about a founder stepping up here and maybe the wheels are falling off?
Anthony, the first thing I think is I'm an idiot. We were rushing from somewhere the other day. I took the kids on the way home. We went and got Domino's, right?
Yeah.
I'm sitting in the thing waiting to pick up our pizza. Do you know what they're selling at the moment? There is a pizza where the crust of the pizza, I'm not joking you here, is made up entirely of mini meat pies. Now, have you ever seen a better reason to short a company than a mini meat pie pizza? I should have made a mozza out of this. And here I am sitting here with you, still having to work for a living. What an idiot!
Did you try one?
I did not buy the meat pie crust pizza. What innovation! Look, I think this is The story of a company that was hot, hot, hot and is coming back to earth.
Yeah.
Domino's, there was a period in the middle of the pandemic when we're all stuck at home ordering as much Domino's as we could shove in our gobs, where Domino's shares were flying. Don Mage, he was, as you say, irrepressible, real charismatic guy. He liked to talk about Domino's not as a pizza joint, but as a tech company, because they would, they had cool pizza boxes and they had an app and all this sort of stuff. I mean, I think they spun a really good story. They went overseas and chased expansion in places like Japan and Belgium and Germany and France, where pizza consumption is an opportunity, I guess. But I think this is just coming down to earth, and people are recognising that the big growth that Domino's enjoyed is over, and things are going to get harder for them. And you can see that. The fact that Van Dijk has left after 8 months, that's always going to spook investors. But I think people are looking past that departure, and they're thinking, hang on, Domino's wants to, its a stated objective is to grow same-store sales by about 3% a year. Is that actually possible? Is that the reason Van Dijk is leaving? Because he's either figured out that this is impossible, or he's been kicked out because he can't make it happen? Anthony, you spoke to Jack Cowan on Wednesday. We're talking about great entrepreneurial success stories on the rich list. This guy is a Canadian bloke who came over here with next to nothing. Hungry Jacks, started Hungry Jacks in Australia, went into Domino's, bridge climb, the Sydney Harbour Bridge thing, he was in that too. What does he say the real problem is here?
Well, according to the man that's been in Domino's since the 80s, James, in a word, it's Uber. Yeah, not that long ago, pizza, think about it, had a monopoly on home delivery. Yeah. It didn't matter whether you were in Australia or anywhere else in the world. If you were feeling a bit lazy, couldn't get out of the house to feed the kids, you'd rely on Dougie from the pizza shop, wouldn't you? 948111. Was that the number in Melbourne as well?
Oh, I can't remember, but I remember Dougie.
It's burnt in the brain. But now you've got the whole gamut of fast food. It's available for home delivery on Uber Eats and other apps. James, and Domino's has a lot more competition. Every pizza shop has a lot more competition. And the COVID-19 pandemic, it really hid that pressure for a few years. It was a big boost for sales, like you said.
Yeah.
But the pressure's been on full display since the end of the 2021 financial year, which is when Domino's earnings per share peaked. Now, in the meantime, James, you've got this pressure coming from Uber, but Domino's just grown. It's grown on this, now got this sprawling empire across Australia, New Zealand, Asia, Europe. All of a sudden, it looks very big, heavy, complex, and challenged. Maybe it's like your party pie encrusted pizza, James, and it's just a bit hard to stomach. Now, the outgoing CEO, he got the simplification program underway, and Domino's has shut 205 underperforming stores. But when I spoke to Cowan, I mean, he couldn't be clearer. He thinks this is a revenue problem and a cost problem, right?
Yeah, okay.
So he's just Domino's needs to sell more pizzas, needs to get that sales line up while also cutting costs, so then it can increase the earnings that its franchisees are making. And when you've got healthy franchisees, you're going to have a healthy franchisor.
Yeah.
So he's not just talking about cutting to greatness. He's focused on that revenue line. But it kind of begs the question, James, and I think the question at the Domino's story for the next 12 months or more is, do you think, is cutting a few underperforming stores, is focusing on sales and costs, is that going to be enough? Or does it need to do something more drastic, do you think? Do you think it needs to chop off some of these territories or restructure itself in a big way because the current model's just busted?
I think it needs to do some pretty radical surgery. And Van Dijk's been doing some of that, particularly in Japan, where Domino's placed a huge bet and has had to retreat. I think they've closed 80 stores or something like that.
Yeah.
Again, worked during the pandemic, not working so well now. So look, I mean, I think they'll have to look at the overseas business. From what I can see, what investors are really watching here is, can they get growth going again in Australia? I think investors want to see that before they'll really trust the overseas expansion. But I think there's probably something worth saving here. Just, Domino's is a franchise, obviously, of a US group. Domino's share price in America, it's up about 51% over the last 2 years. And of course, Uber and food delivery services over in America are even bigger. So there is a way to get through this. I imagine Cowan will be looking to America and saying, what fixes have you guys put in place? What should we change? Do we strip things back and, focus more on our core product? But yeah, you're right. It's about what they need to do is to make sure their franchisees are making money. What you want to be able to do with one of these franchise stores is for the franchisee to get payback in about 3 years.
Yeah.
And that's not happening at the moment. And so if you can't get your franchisee payback in 3 years, that means they won't buy another store and another store and another store after that. So that's the thing they've got to concentrate on. Ironically, maybe Jack Cowan's the person to get in there and rev things up. A bit of an old school approach, bit of a back to basics thing. Will investors flock to that, do you think?
Look, maybe they like Jack, but this definitely came out of the blue. They were surprised. That's why the stock got sold off. And Jack at least fronted up. He fronted investors one day after on Thursday, gave them an explanation for it. But I think people are still scratching their heads about exactly why and what happened and who's to blame and all that sort of stuff. But in terms of the actual share price, James, it's this one's really important. It shows you how share prices move, why share prices go up, go down so fast and so slow. So the old Domino's, it was really good at growing earnings. Like if you go back to 2010, it was making 26 cents a share in earnings. So every share out there in the company, each year you got 26 cents worth of profit, right?
Yep.
Every year on year, that increase went from 26 cents to 31, 38, 41, 73, just kept going all the way up to the end of 2021 when it was $2.12 a share.
Wow.
In earnings. So it was one of the ASX's sort of flagship growth stocks. Yeah. It was on the right trajectory.
Yeah.
Now, if you think of the way that companies are valued, there's two things that determine the value. It's that profit forecast. And if you see the trajectory going up and to the right, you keep the forecast going up and to the right. And it's the multiple. So it's how many times that you put on a year's worth of profit to come up with the share price. Now, what happens when you get a big upgrade or downgrade, James? If you put the forecast up and the multiple up, you get a big uplift. If the forecast comes down, the multiple comes down, it really falls through the floor.
Yeah.
And unfortunately, that's where Domino's is at the moment, James. So it's got its earnings have been dropping. The multiple that people will pay for the earnings have been dropping because they're worried that the growth era is just gone. And it's sort of stuck in the worst of both worlds and it needs to find its bottom. And we thought like a few months ago, James, that Domino's had found its bottom, right? There's these new CEOs come in, he's making the right noises, he's closing stores, he's talking about performance, not growth, all that sort of stuff. It looked like it might have found a bottom, but the share price just kept bleeding lower and lower. And then this week, James, it took a massive step lower again. So I know some investors are just out there wondering about when it's going to find that bottom. We all know what Domino's is. There's a decent business there.
Yep.
It's just a matter of should it be in all these places it is now, and what should you pay for it?
Yep. Drop the pie crust pizza back to the margarita, and everything will be okay. I think. All right, we'll come back after the break. Huge week next week. Big day for the RBA on Tuesday, and a big night for Donald Trump on Wednesday night. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Anthony, RBA day on Tuesday. Will they or won't they? Every major bank says they will cut rates. Are you as convinced?
Yeah, I mean, it's one-way traffic, isn't it, saying cut rates? I mean, personally, I'm not really seeing the near-term need, James. I think the job market's still tight. Inflation's back in the range, but we need to consolidate that. I think we're better off keeping a bit of firepower up our sleeve. But who am I to say that, James? The whole street of traffic is running towards a 25 basis point cut.
Yeah, I think they'll cut. Whether they cut and hold for a bit longer now is the question. I think it's reasonable to cut, but you want to be circumspect after that. Wednesday, we've got some building permits data. We had some interesting house price data out this week, just showing House prices are responding to rate cuts and starting to rise again. Who would have thunk it?
Mm-hmm.
We need building permits to rise too, so we get more supply in the market. And then Wednesday night, Anthony, is the official end of the deadline for Donald Trump's big tariff pause. And nobody knows what's going to happen here. He was supposed to have 90 deals done in 90 days. I think he's got one crappy deal done with Britain, a sort of half-assed one done with Vietnam, but nothing else. I mean, this is... You have any idea what's going to happen here? Surely he just kicks the can down the road, doesn't he?
Yeah, I agree. The deadline's not really worth too much.
My one caveat is Mr. Art of the Deal needs to whack someone. He needs to show he means business. So I won't be surprised if he chooses maybe a Southeast Asian country, that is closely aligned with China or, does a lot of manufacturing, and he hits them with a tariff to say, look, I still can do this if I want to. Might only be temporary. But I reckon there's something like that. But I think investors will look at it and go, oh, come on, Donald. We know you're going to back down pretty quickly. So there might be a little bit of volatility on the markets, but probably not the sort of big bang that we saw in early April, or hopefully anyway. All right, Anthony, we took a question earlier about super. We've got another question from Mark Piramelli from Western Australia. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And you can also enter a question via the Chanticleer widget on all our Chanticleer articles at afr.com. And that's exactly what Mark's done. He asks, is it too late to get into NVIDIA? And do you think markets will push on from here or correct? Now, Anthony, that is beyond our crystal ball, and we've got to emphasise that we're not giving personal advice in any way, shape or form. But I just wanted to share with you an analogy that Mark Delaney from AusSuper gave us. And he compared NVIDIA to the mining companies, back in the mining boom around 2014 when China was going nuts. And he made the point that NVIDIA's earnings per share have gone up tenfold in 3 years.
Yep.
What's the only other sector where we've seen that happen? Mining, during the China boom, when, the price of iron ore just went up and up and up and demand just went up and up and up. But he made the point, and this might not be so helpful, Mark, but he made the point that no one wanted to be long iron ore stocks at the top of the cycle, and you don't want to be long NVIDIA at the top of the sort of AI cycle. It's just a little reminder, I think, that NVIDIA's got amazing growth ahead of it. AI boom is very real, and this thing can keep running for a while. But there will be a point where you hit the peak and you start to come down. I got no idea when that peak is, but I think it's interesting that a big investor like Mark Delaney at AusSuper's just wary of that at the moment, I reckon.
Yeah, it's a good point, James. Like, he's talking about earnings there at NVIDIA, like their actual earnings. Like, he's making a ton of money. So while the shares have gone nuts, like its profits have kind of kept up. It's trading at about 32 times their coming 12 months profit, which, I mean, it's probably 10 multiple points more than the wider market, but like, it's not as insane as you necessarily think.
No, that's right. That's right. Hopefully that helps a little bit, Mark. Anthony, well, you've got to do your bit for the country this weekend. Get out there and get a few meat lovers into you, I think, and try and help Jack Cowan at Dominos turn things around.
Thank you, James. Have a good weekend yourself.
We'll talk to you next week. Thanks for listening. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Mandy Coulin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.